I understand that seeing the stock market go up day in and day out can make you just want to throw as much money in as you possibly can and just watch it ride to Tendy Town. But you're afraid that right when you buy in, it'll only go down from there. Truth is, that's a real possibility. I mean, just look at Japan in 1989. All-time highs, and still hasn't even come close to returning to that point in over 30 years later. But I'll outline the risk later on in the video, because while I'm extremely bullish on the United States economy for the foreseeable future, it is important for me to outline the very real risks that come with investing in the stock market. But I'll get to that in a minute, because currently I want to tell you why the best time to start investing in the stock market is right now. Hey, what's going on, guys? My name is Evan.
And welcome to the Financial Dominance YouTube channel.
So usually when somebody mentions investing in the stock market, they're usually referring to the S&P 500, which is a single fund that holds a slice of each and every one of the top 500 companies in the US. It's typically regarded as one of the safest investments you can make, and is typically regarded as the benchmark as to which all other investors compare their results to. So the average annual rate of return for the S&P 500 is typically 10%, and 2 of that 10% being dividends. So already, if you have a bunch of cash gaining 0% interest in a bank account, as long as you don't need that money anytime in the near future, you're already better off investing in the S&P 500 index, because those 2% of dividends that you'll get already hedge against inflation. And we'll get into picking your own stocks versus buying the index later in the video, because that's what I personally do, and there is real benefits to that. But we'll get to that later. So for example, let's say you put 10 grand into SPY, which tracks the S&P 500. In only 1 year, not even doing anything, on average, you'd have 11 grand gaining $1,000 in capital gains and dividends, not doing anything. And then your second year, you'd have 12.2 grand. See, the second year, it's already more than 1 grand in capital gains already, because that first grand you gained in the first year is already working for you in that second year. And that same principle goes into the third year, which then you'd have 13.5 grand. See, it speeds up the growth as you go. It's not just linear growth. The gains then go on to grow on top of themselves, and that's called compound interest. All the way out to your 7th year, you double your money, not doing anything with it, just by swiping up on Robinhood and reinvesting the dividends through their dividend reinvestment program, or DRIP for short. And all of this is opposed to just keeping your money in your bank account being eaten by inflation, which would only be $8,500 after 7 years. It literally costs you money to save money. And not in the sense that it would actually show $8,500 in your bank account after 7 years of not touching it, but 10 grand in 7 years would only have the buying power of $8,500. Basically, your money is worth less and less when not invested in assets like real estate or the stock market. Just for fun, here's what 30 years of compound interest would look like. It just compounds and compounds and compounds until your investments are making more than you can. And that's all just from that one initial investment. Over the span of 30 years, you would literally turn 10 grand into almost $250,000. And here's what it would be like if you actually added another $1,000 a month, which is closer to reality, because ideally you'd take a little bit out of every paycheck and just automatically deposit it into your brokerage. Or at least that's what I do. This could literally be you if you just automatically deposit a couple $100 a week. You could literally be a multimillionaire by just automating things on Robinhood. I personally use Robinhood, and I know on Robinhood you can literally automate deposits, share purchases, dividend reinvestments. You'll be paid from those shares, and just forget about it. For years, automating the whole process, and just one day wake up and be like, oh yeah, I'm rich. Not to mention the dividends that you'd get from a couple $1,000,000 invested after doing this for like 30 years would literally be the equivalent of the average household American income. By not doing anything, you could just be making 40 grand a year, just sitting back, relaxing, and letting your money work for you. I mean, it's actually crazy to think about that you could just do this, and like, so many people don't even do this. So just imagine what it would be like if you started in your 20s and you just wake up one day when you're 50, which is still very young with a lot of life left to live. Say you live to 80, that's still 30 years. And I don't know if you're a teen or a young adult like me, it's hard to imagine, but you just gotta think long term, because one day we're all gonna be there, and you're gonna be a lot better then for it. for just thinking about it now and planning for the future. But all this to say, my point is just basically that you could literally mindlessly make it to your 50s, and you could passively be making the equivalent of the average American household with no more than the education from a 10 to 15 minute YouTube video. I forget who it was, but one time I heard somebody say that investing in the S&P 500 is basically like you're going to class and your teacher tells you that if you just show up day in, day out, just show up, don't put in any work, don't do any studying, don't do any research, just show up and sit in the class day in, day out, they will give you a B. Basically saying that investing passively, as long as you just do it for the long term on a regular basis, you're going to be okay. You're going to make a lot of money, and you're going to double your money several times on the way. And you're going to get paid a lot of dividends, and eventually you're just going to have so much accumulated that you'll just be able to live off those dividends if you want. And then obviously if your teacher, the teacher, you'd get an A by doing your research, picking your own stocks, but we'll get into that later. But I mean, to you, a B might sound great. And I mean, to me, it sounds great. I mean, hey, that's pretty close to an A, especially if you have a business or you work a lot of hours or you just don't care to do all the research and you'd rather play video games in your spare time, which is totally fine. The fact that you guys are even thinking about investing is going to put you so far ahead of the game in the long term that it's just unbelievable how many people don't even think about investing and building wealth until way too late in life. So passive investing sounds great, right? Well, it's not all perfect. While chances are and statistics show that you'll be very well off by just investing in the index, it's important to understand the risks. There's always the possibility that it goes down. As simple and elementary as it sounds, this is where things could fall apart for you if you're not mentally prepared. Psychology and controlling your emotions and not being impulsive and sticking to your plan is 90% of investing. What happens when there's a big market correction? A flash crash, a housing crisis like in 08, a global threat like we're going through now. Every time you see one of these big dips in stock market charts, that's the result of there being a huge amount of sellers compared to the buyers in the market, usually driven from fear, thus driving the stock prices down because there's a high supply of the stock, a low demand to buy it, thus lowering the price. And that's because people are afraid to see their numbers go down, not realizing that they aren't just investing in some made up numbers on a screen. They're investing in a fund that holds a little piece of the 500 best companies in the United States, much of which are the best companies in the whole world. If the market crashes, do you sell your house? Obviously not, but why? It's an asset. It provides shelter. It provides value to you. Just as if the market crashes, does Jeff Bezos sell his remaining stake in Amazon? No. But why? It's a business. It's creating value. Just as your home provides shelter to you, businesses provide value to their customers and therefore provide value to their shareholders in the form of capital gains as the company becomes worth more and more by growing revenues and profits. For example, Tesla is rapidly growing, so their cash is best held onto and reinvested in their own company, thus driving up revenue and earnings and profits, and that's how they deliver profits back to their shareholders, by capital appreciation. Also, dividends, which is my personal favorite, is another way that some companies return profits back to their shareholders. If the company is so big and profitable already that any extra cash does them no good and won't lead to more growth, they'll just pay it to you as a shareholder, the part owner of that business. For example, JP Morgan is a company that is so big and so profitable that if you own any shares of that company, they'll send you a check every single quarter to give you some of the profits from that little piece of the company that you personally own. Obviously, a share or two of JP Morgan will only make you a couple bucks a year in dividends, but you get my point. The more shares you own, the more you get paid. Then you can reinvest the dividends, and then it grows faster and faster, like we talked about earlier, in that compounding interest effect. Basically, my point is that you can't mentally disconnect those shares you see on Robinhood from the underlying business that you actually do own a piece of. When you buy a share of SPY, the S&P 500 index, you're now a part owner of Microsoft, Amazon, Facebook, Apple, Google. Almost any big company you can think of, they're probably part of the S&P 500. So if you think America will keep growing GDP year by year, like we have for the past several decades, then you'll be all right. And just for the extra peace of mind, if you had bought at the peak of the market in 07, right before the 08 housing crash, you would have taken a 50% hit in the short term, but if you just held on, currently you would be up 115%, averaging 11% a year, not even including dividends. Just like in this past year, if you had bought the February highs right before this global threat hit, you'd actually be flat. The market has fully recovered and is retesting new all-time highs only 6 months later. And actually, I'm pretty sure they just passed the all-time highs today. And there's so many businesses in the S&P 500 that still have yet to recover. So I wouldn't be surprised if we saw, as these companies recover, even more of a run-up in the stock prices, just pushing through highs and pushing through highs and pushing through highs. And while, yeah, I did tell you buying the index is a great way to get a B in the class by just showing up, now I'm going to tell you how to get an A. Because at the end of the day, I don't mind doing my own research and reading balance sheets and annual reports and listening to earnings calls. Because at the end of the day, while an index can be a consistent way to get a 10% average, picking your own stocks is how you're going to get truly wild returns. For example, I bought some Tesla during these March lows, knowing that for sure the short term it might go down, but from all the research I've done, I knew this company was insane, and they're literally going to the moon. Like Elon's trying to go to Mars, so it's not even going to the moon, it's going past the moon to Mars. But before I even bought any Tesla stock, I listened to the earnings calls. I researched the CEO and how he thinks. I was inspired by Elon and watching all these cheesy motivation videos before I even thought about buying the first share. And these are the types of returns you can get by picking your own stocks. Obviously, Tesla is an outlier and most companies won't give you these returns this quick, but I'm only showing this position of mine to hopefully inspire you guys to see what is possible when you deeply understand a company. And that's only holding the stock for 5 months. Imagine what it's going to be like in 5 years. The other benefit of picking your own stocks is in situations like we're in now, we'll probably see a lot of shares of Apple, Amazon, Microsoft, Facebook, and a lot of other big tech sell off, and all that money will be flooded into recovery stocks like Carnival, Wynn, Cheesecake Factory, Darden Restaurants, all companies which I own, and I fully anticipate to see some massive capital gains growth here shortly as we get closer and closer to a full recovery. And it's already started this last week, not to mention in the next year or two, they'll all be starting to pay dividends again. And not only will my capital gains beat the market, but I'll also have a much higher dividend yield percent when they inevitably do come back. So yeah, if we do have a sell-off, a big tech sell-off, like a big market crash sell-off from tech, because they're the heaviest weighted companies in the S&P 500, if that does happen, then I'll just buy in, I'll just get some discounted shares of Apple or something. And that's the great thing about picking your own stocks, is when things fluctuate like that, you can just snatch up deals. And it's not about trying to time the market dips with buying stocks, but rather having automatic deposits on every week and just buying whatever stocks on your well-researched watch lists are on sale that week that you think will do very well over the next 3 to 5 years. Basically what I'm saying is if the market is up, then I buy. If the market is down, then I buy. But when picking your own stocks, you have the power to choose your entry points in the stocks rather than buying broad funds that when you're buying them, you're buying every company at whatever price it is that day, no matter what, instead of getting the best deal at that time to squeeze out a few extra percentage points, which adds up big in the long run. It's never too late to start investing because, as I say, today is the second best day to start investing. The first day was 10 years ago. My point is, whether you decide to buy the index or pick your own stocks, have a long time horizon in mind and don't get too caught up in the day-to-day fluctuations of the stock market. And always invest in a way that lets you sleep well at night, because there's nothing worse than having the urge to check Robinhood every 5 minutes. So with that said, guys, thank you so much for watching. Leave a like if you enjoyed, sub if you're new, and yeah, I'll see you guys in the next one. Later.